So now let's extend our example a little bit further, ultimately making the point that the budgeting process is hardly a linear one. It's never the case that a firm starts with sales budget, works down to a cash budget, and then is complete. Usually a lot of what we learn at the cash budget level informs the recreation of previously created budgets. Now turning back to our example, recall that at the end of quarter 3, our cash balance after operations was less than the required cash threshold, and we anticipated having to take out a loan. We also assumed that we were going to have to pay back some interest on that loan in quarter 4. And short of covering quarter 4's deficit, let's look at what the implication of this interest payment has on the previously created budgets. Specifically, let's turn back to the budgeted income statement. The original budgeted income statement suggested we had net income of $7,707. However, that was based on interest expense that was less than what we project for quarter 4. We had not anticipated the need for financing at the time that we created this original budgeted income statement. A revised budgeted income statement, based on what we have learned from the cash flow statement, would suggest that we have an additional $2,000 in interest expense that would occur throughout the year, specifically in quarter 4. This has implications for the income before taxes number that we've budgeted, as well as the income tax expense that we calculate. So rather than earning over $7,700 for the year, net income is actually $6,407 in this revised budgeted income statement. So as you can see, the budgeting process is hardly linear. It's quite iterative, in fact. What Hogarth managers learned via creating the cash budget informed a revised budgeted income statement. Managers oftentimes go through a lengthy process back and forth between the individual budgets until the right targets and goals are set.